Hello, everybody. My name is Maurice Button, and I'm the CEO of City and Financial Global. And it's my great pleasure today to be interviewing Dr. Peter Golder, who's head of Group Digital Asset of the London Stock Exchange Group. Peter, welcome.
Thanks, Maurice. Pleasure to be here.
Let's get to our first question, if we may. Please, can you describe to our viewers the advantage of digital market infrastructure platforms and the differences, perhaps, over traditional financial markets infrastructure providers?
Sure. I think there are a couple of ones and different ways of looking at this. I think the main starting point is that when you look at the underlying assets, so infrastructure is great, but what actually trades on that infrastructure? And
yes,
that's where we have to acknowledge that there is a paradigm shift going on. The expectation is that in about 10 years' time, largely 10% of global GDP will be stored, transacted on ledger, on blockchain. And one of the key questions is, well, how do you get into that universe, and what kind of infrastructure do you need to have to participate in that space? And when you think about the creation of these digital assets, what creates them is tokenization. So and that depends very much on what your starting point is. So if you have a conventional asset, then you convert that asset into a digital security, and that's then a security token. And the advantage of that is that, first of all, the infrastructure, because it's all digital, can look at that underlying asset from an asset agnostic perspective. So in essence, it's, for example, an ERC20 type token or the derivative thereof, but the machine, the infrastructure, doesn't really distinguish whether the underlying is a basket, a single stock, fixed income, or real estate, or any type of other asset. And as you move that token, which represents a security, through the value chain, you can automate pretty much the entire process end to end. So a lot of the inefficiencies that we can observe today, particularly around reconciliations or multi-point reconciliations, all of that falls away because you have the entire ecosystem on that platform. So paying a dividend, voting, all of that can be automated through a smart contract, which is in essence a combination of the security and logic that then can run end to end over the entire life cycle of that security.
And that's quite a revolution. I guess it has implications for things like, for instance, liquidity. How do you ensure that there's sufficient liquidity on DMI platforms?
Good question. I think what we have to acknowledge here is that, first of all, it's a question of how do you solve for client adoption? How do you think about ecosystems, and how do you incentivize people to be part of that alternative ecosystem? But it's very much a starting point question. So if you start with an asset class where you have high SDP rates and existing infrastructure, there's a different strategy required to think about that, as opposed to an asset class where you have no infrastructure and you have a very large asset class. So if you think about private markets, for instance, it's a multiple the size of the listed side of the house, but there is relatively little infrastructure. There are information asymmetries, transparency gaps between the different actors in that space. So the starting point between those is very different. And what's interesting is, for instance, on the private market side, there is lots of interest to get into that space in a cost-efficient way, either for people who understand the asset class, have had exposure to the asset class before and want to do more, faster, better, cheaper, or people who are sort of on the verge of wanting to invest but it's been traditionally very expensive for them to get into that space. So there's that democratization effect where you, in essence, open up a new asset class to new investors, or the investors that have already engaged, you allow them to do more of the same, faster, better, cheaper. And above and beyond that, what's interesting when you look at the crypto world, incentivization, token economics is a great example of how you can incentivize people to accelerate adoption of new paradigms, new markets. And I think we can borrow some of that as we think about rolling out new infrastructure to new markets.
What about the role of different actors then? I mean, traditionally, if you look at financial market infrastructure providers, you'd have players such as market intermediaries or market makers. What happens to them? Are they redundant in the new world of DMIs?
I wouldn't say they are redundant. I think in a lot of cases, the function of what you want different actors to do across the value chain doesn't go away just because you have a different paradigm. The way you can perform that function can change. So I look at this and I see lots of opportunities for new players and new intermediaries to emerge. And what's really exciting is the ability to increase automation, to create different business models which leverage the underlying infrastructure in novel ways. You can also think about ultimately how do you reduce the risk in these markets, and so there is a role for risk reduction, for instance, and that can be manifest itself in a number of different ways. But what you're trying to do is you're trying to address some of these traditional inefficiencies, and whether that's through a smart contract, if you think about that as a form of intermediation, or it could be a different firm, a different player. But some of the fundamentals don't necessarily go away. It's just you have different means by which you can reduce some of those functions that need to be performed.
You touched on the role of smart contracts. Could you expand on that a little bit? I mean, presumably an awful lot of activities can be contained within smart contracts and executed by code. Could you explain that a little bit more?
Yeah, so in the past, you had an asset class view, so you have equities, and then you have logic over the life cycle of that asset, and at certain points in time, those things need to come together. So you pre-trade, trade, clearing and settlement, and then on the post-trade side, you have asset servicing. And every once in a while, or predefined moments in time, you then have to consult logic to think about what do I need to do end of the year, who is eligible for a dividend payment, and how do I need to distribute that once I figured out what that payment actually is. And here you could say I automate most of that, therefore I don't have to reconcile. I create more transparency across that, and there is no need for the asset and the logic to be separated. So as part of the tokenization, you create that smart contract, and the logic and the asset basically are together. And the computer can then check end of the year, consult the logic that's embedded in that asset, and then pay dividend, having consulted maybe through an oracle the cap table, and there it's clear who is eligible for a dividend payment, how much that dividend payment is, and I can then automate all of that. There's no need for reconciliation. I have the transparency on the back of that. All the reporting can be automated, so you kind of have that cascade effect across the entire chain.
Absolutely fascinating. I mean, it's a much better new world that's coming. Finally, what question would you pose to our viewers to get them to focus on the evolving digital assets revolution? What do they need to focus on, do you think? If
I
there's
think
one thing in particular.
I think it sort of starts with what I said initially, that we need to, or as an ecosystem participant, we need to understand, and all the players need to understand and sort of feel comfortable with the fact that we are going through secular change, and that 10% of GDP being tokenized in roughly 10 years, that's a big number.
Sure.
Yeah, in absolute and relative terms. Understanding what that means from a market perspective, but then also from an individual participation perspective is very important. And then the question really is, if we're playing a new game, how do I get into that new game? What are the rules of that new game? And how do I want to participate in that? So for instance, do I want to be an early adopter? Do I want to be a fast follower? What kind of changes from an infrastructure perspective do I need to make? What is it that my clients actually want? How do I react to that? And as we're going through this transition, how do I deal with change as an organization? Because that's a journey. We're not going to switch everything from analog to digital, if you allow me to use those terms. It's a journey. We're building an ecosystem. How do we migrate from one to the other? Where do I want to start this journey? Asset class, method. You have different options, and probably every firm is slightly different. So we all collectively need to think about building that ecosystem, but each firm has a different starting point.
Peter, a really interesting conversation. I've enjoyed it immensely, and I look forward to continuing it at the summit itself, which is our Institutional Digital Asset and Crypto Regulation Summit, being held on the 17th to the 18th of November in London. I very much look forward to seeing you there. Thank you very much for your time today.
Thank you, Maurice, and I look forward to the panel.